Wake up to free tokens in your wallet. It feels like winning the lottery, but be careful. Most tax offices don't see airdrops as a gift. They see them as a paycheck. In this video, we're covering the tricky tax rules for crypto airdrops, where you might be taxed twice, and a few lucky countries where airdrops are usually tax-free. Airdrops are a popular way for new projects to build hype by distributing free tokens to early users. But free is a relative term. In many jurisdictions, receiving an airdrop triggers a taxable event immediately, even if you haven't sold a single token. Generally, you are looking at two potential tax points: income tax when you receive it, and capital gains tax when you eventually sell it. Let's break down how this works across the globe. Okay, the general rule: income versus capital gains. For most investors, the taxman treats an airdrop like a bonus at work. Step 1. Income tax. On the day the tokens land in your wallet, you must calculate their fair market value in your local currency. This amount is added to your annual income and taxed at your regular income tax rate. Step 2. Capital gains tax. Later, if you sell those tokens, you pay capital gains tax on any profits made above the original value. Essentially, your cost basis becomes the value you paid income tax on. Okay, country by country breakdown. The rules vary wildly depending on your passport. So here's a rapid fire update for 2026. US, IRS, airdrops are income. You report the fair market value on the day of the receipt as other income in your Schedule 1. When you sell, you report capital gains using Form 8949. Okay, number 2, UK, the HMRC. It really depends. If you did something to earn it, like a task or a past trade, it's income. If it was truly unsolicited, meaning passive, it's usually tax-free on the receipt. Okay, Australia, the ATO. Generally income. However, initial allocation airdrops might be tax-free on receipt. Canada, the CRA. Good news here, the CRA generally doesn't view airdrops as income, unless you're a business. But the catch is, your cost basis is zero. So when you sell, 100% of the sale price is a capital gain. Okay, Germany, the best scenario. Airdrops are often seen as a lottery win, tax-free on receipt, and often tax-free on sale since there was no purchase. Okay, let's talk about the double tax trap. The biggest mistake we see: failing to track cost basis. If you pay income tax on an airdrop worth $500, that $500 is your cost basis. If you sell later for $600, you only owe capital gains tax on the $100 profit. But if you don't record the initial value, the tax office might assume your cost basis is zero, meaning you pay tax on the full $600. Don't pay tax on the same money twice. Okay, so how does Koinly help? Tracking the fair market value of a token the exact minute it hit your wallet years ago is a nightmare. Koinly handles this automatically. When you sync your wallets, Koinly detects airdrops. You can head over to your settings and toggle treat airdrops as income, and that can be on or off, depending on your local laws, like turning it off for Canada or Germany. Koinly establishes your cost basis automatically, ensuring you only pay the correct capital gains when you sell. Alrighty, airdrops are a great way to build a portfolio, but they come with paperwork attached. Whether you're farming airdrops or you just got lucky, make sure you know the rules for your specific country. If you want to check your potential tax bill right now, you can sign up to Koinly for free using the link down below. I hope you found this video helpful. If you did, consider dropping a like, subscribing for more crypto content, and I'll see you next time. Peace.